Thank you to all our speakers. We now begin our opening plenary. It's on mobilizing domestic capital at scale. What does it take? This session is supported by GSG, Japan, and the Ministry of Food and Agriculture. Let's welcome our moderator, partner at Cardinal Stone Capital Advisors, Shirley Somwa. And this speaker's CIO and MD of Access Wealth, Peter Bewa, CEO, Impact Investing Ghana, Amalate, Managing Director of Petra Trust Company Limited, Kofi Finn, and Vice President Investments at Kuramo Capital, Olamide Adeosun. Let's welcome all our speakers and our moderator.
Hello, everybody, and good morning.
Morning.
Good morning to the panel as well. As Kafui said, my name is Shirley Somwa. I'm a partner with Cardinal Stone Capital Advisors, and along with two partners, we run a West Africa-focused private equity business. I'll let each of the panelists do a quick 1-minute introduction, and then we can get into it.
All right, thank you. Good morning to everybody. So my name is Peter, like you mentioned. I do work with Access Wealth Management and Access Pensions. So I'm the CIO on the pension side and wealth manager. I manage the wealth management division. I just joined Access about a year ago. Prior to that, I was in the US for over 20 years in different roles, from wealth management to investment banking and everything else in between. I just moved back, relocated last year with my family. And part of the reason was to bring, the skills and talent that I learned over there to come and impact, our communities and our continent. And so I'm excited to be here. Thank you for having me.
Hi, I feel like I've already said hello to everybody, but Impact Investing Ghana is a nonprofit that is really working to bring the ecosystem together to collaborate, to capture some opportunities we have, like unlocking capital, or to fill a gap that we have. So we create collaborative groups that have a task, which is to fix a problem, and they create products, services that add value to Ghanaian society and to the financial services and entrepreneurship sector.
Hi, good morning, everyone. My name is Olamide Adeosun. I'm a principal at Kuramo Capital. First, let me thank Ama and the IIG team for inviting me here to speak. Kuramo is a fund manager based out of Lagos, Nigeria. We've been around for about 15 years, and over that time, we've helped to catalyze about 3.5 billion to the continent and create about 650,000 jobs. So thank you for having us.
Good morning. My name is Kofi Finn, and I'm Managing Director of Petra Trust. We are a pension trustee based here in Ghana. Very happy to hear about the job creation that Kuramo has done. When we started Petra, our goal was to end up creating about 100,000 jobs. We are significantly below that, so we still have quite a bit of work to do, but it's a pleasure to be here. Thank you.
Thank you, everybody. So over the course of today, we're talking a lot about impact investing, but as I think Lamide and Kofi have started to say, what's the end goal? It's how do we achieve transformative economic development in our countries, and a big measure of that is job creation. I think if you look at many developed economies around the world, domestic capital, pension funds, insurance are significant investors in infrastructure and in companies that catalyze job creation. And so in our conversation today in saying what does it take to achieve investment at scale, that's the framing of the discussion. The focus today, partly given the panelists, but also the scale, is a bit more on pensions and other sources of domestic capital. And in Ghana, there's, call it 100 billion cedis or so of domestic pension capital. Most of that invested in government securities of some form, very little driving real sector development. How do we change that? What does it take? We're having this conversation also in a context of a shifting funding landscape globally, which we don't have control over, of some significant shocks we've had domestically through the debt exchange program and related, I suppose, fallouts of that. And so I'm hoping we can have a discussion today on what people who are actually investing in the economy today are seeing, how they're thinking about it from an asset allocation perspective, and what other players in the ecosystem can do to help catalyze this. I'll start with you, Kofi and Peter, and perhaps Kofi, I'll start with you on the end. It would be great to hear a little bit about what you're seeing today. Where are you investing? What have you done in alternatives? And how do you think of that as part of your broader asset allocation strategy?
Thank you. So for us, alternatives are a very important asset class. In fact, we think of it as the primary asset class for a couple of reasons. I think we're all very excited about what's going on in the public equity markets. The Ghana Stock Exchange is doing really well. We hear all the good things about it. Most of the volume, more than 90% of the volume is driven by one stock, and that's MTN. And if you try to get into any equity in size or to get out of it, you're going to move the market significantly. For us, it doesn't fit the definition of an investable asset class, given the size of funds that we're managing. And so to get our equity exposure, we need to look elsewhere. And alternatives are the area in which we're trying to focus. The question then comes, which is how do you find these assets? What are the companies or infrastructure assets or other kinds of industrial assets that you can invest in? And very, very difficult to find. We are ending up having to look to create those assets in order for us to have something to invest in. And that should not be the case. But we need to be able to find things that are big enough, large enough, that can give us that differentiated exposure to take us away from government securities towards investing in the real economy. If we can do that creation bit, the stock exchange then becomes a natural part of exit, and over time we expect that forum will become more viable, more active, have a lot more liquidity, but that's somewhere in the future. So today, we need to spend time, even at the asset allocation level, thinking through what are the companies, infrastructure assets, industrial assets, energy, whatever it may be, that we can force to be created for us to be able to invest. That makes the job really, really difficult. And it has to happen at scale.
Thanks, Kofi. Just one follow-on on that. I think most trustees today have less than 1% in alternatives. How do you think about what a good medium-term target is, both for the industry and perhaps for yourselves in particular?
If you look at, most developed country asset allocations, you're looking for a balanced kind of structure. It's usually your 60-40, right? Even if we were to say, look, let's balance it out equally and have a 50-50 equity to fixed income allocation, that makes sense as to where we need to get to. Obviously, there's a lot more volatility in an environment. You might have to take a little bit more risk to account for that volatility, but there should be significantly more in non-fixed income assets, both equities and real assets. And that the path to that has to be done with some level of aggression. We've been very, very passive. Our industry has been in place for 15 years. After 15 years, we still have single-digit allocations to non-fixed income asset classes. That's not acceptable. But there are structural reasons why. And if those structural reasons are not addressed, we will still continue at this slow pace with individual pension companies or investment companies pushing against the tide to try to get this allocation done. The policies and structures of our economy have to be looked at to ensure that we can do this much more easily so that the change can happen.
Thanks, Kofi, and we'll come back to some of the structural issues. Peter, let me come to you. Along with Petra, Axis have been pioneers in alternative investing. I think both of you probably did your first investments close to 10 years ago. Can you speak a little bit more to also what you see the role to be and perhaps some flavor on what have you found to invest in alternatives?
So thank you for that question. So similar to Kofi's point, we do see a lot of opportunities in the alternative space. However, it's not as deep as the public markets. Our economy is still, obviously developing, still very young. Alternatives are very, very new. In general, investors in that part of the world have been very conservative. They're used to, investments going only one direction, which is up. And so they don't expect, positions to come down at any point in time, which is not what real investing is. If any investor tells me that their assets are only going up, that's suspicious. That's like penny made of. And so real investing involves volatility. Part of the problem has been, investor education in our part of the world. And so people need to get to the point of view that, when you invest, especially for the long term, you're going to experience some volatility. And that will help, other asset classes such as, alternative investments that do not always result in, positive returns right away after going through the J curve and all other complexities. Eventually things work out, but we need to come to an understanding that, investing in fixed income only is not a way to go. So that's one part of the question. But the way we look at it at Access is our primary responsibility, our primary fiduciary responsibility is to our investors, right? Beneficiaries of our pension plans. At the end of the day, somebody is giving you money to invest for them so that when they retire, they can be comfortable in their retirement when there's no more income coming in. And there are two ways to achieve that, right? So we're looking at income from the investment and you're looking at capital appreciation. Now, when you look at our income, if somebody is not close to retirement or in retirement, they don't need income at that point. So if you have a young investor who has 40 years to retire and you put in those assets into fixed income, you're doing a disservice to that investor. I believe that younger investors should have more allocation to equities and alternative investments, whereas investors that are in retirement or close to retirement that need income should be getting more of the fixed income investments. Now, the way our asset allocation is structured, as far as the pension regulations go, we are supposed to be investing up to 70%, sometimes 75% in fixed income assets. That doesn't do, the investor any good. History has shown that over the long term, the best hedge against inflation is equities. Fixed income has actually underperformed. And then when you convert the returns into dollar terms, it's even negative. So at the end of the day, what are we doing to our investors? And I know there is a patriotic aspect to it as far as investing in government bonds and all that. But the ultimate responsibility is to make sure that our investors are in a better place when they invest. And so there should be some reform as far as our pension regulations go that allows at least 50% to equities. But having 75% to fixed income, that is not sustainable long term. So that's the way I look at it. And that will also give room for more alternative investments to come into the picture.
Okay, thanks a lot, Peter. I'll come back to pick up on some of those points on both expectations around perhaps some of your trust boards and also regulations. And we have regulators in the room, so a good time to have the discussion. Lamide, let me come to you next. I think depending on where the Naira is on any day, Nigeria pension assets are at least 2 to 3 times, I think at some points 4, more substantive than in Ghana. And historically, I think Nigerian pension funds have a longer track record of investing in alternatives. It would be great to hear from you your sense of what some of those enablers have been, but perhaps some of the pain points also in trying to channel more into alternatives in Nigeria.
Yeah, thanks. Karama, we're here today really because we're the fund manager for the Wholesale Impact Investment Fund, sponsored by Impact Investing Nigeria and the GSG. And what we're trying to do with this product is really build a next generation of SME fund managers and crowd in local institutional capital. This panel is about creating impact at scale. To do that, the largest pools of capital are the pension funds. In Nigeria, pension funds have invested historically in the past, but it's similar here, not much. I mean, less than 1%, 1% of their AUM. And really, the challenges that they found historically were they were investing in dollars, so there was a currency mismatch. They were also, the long lockup period and hold period was also a challenge for them. Nigeria went through crazy macros, which led a lot of fund managers to extend the lives of their funds. And that was a bit challenging for some, for local pension fund managers. But really, I think what needs to happen, I mean, there are two ways that you have to do. So basically, you have to convince these guys that, they need to basically have a double bottom line. They need to look at returns, but also look at the impact and investing in the real sector, the real economy. And then also you need to convince them that your strategy is the best strategy to invest. What we've found, we've spoken to, almost every pension fund in Nigeria. So we've done a lot of work on that, and we're still working to help and educate them on the risk reward and risk trade-off of investing into the impact space. And then we've also developed our model, which is the ABCD model, where we have an accelerator, which basically accelerates SME fund managers. So we did that on the gender lens side. We identified over 100 women-led fund managers. We put 45 through that program, and I believe 3 have gone on to raise capital. And so what we're doing now with the WIF is we're doing the same thing. So we've gotten backing from the Riser Foundation, also Gates, to do a similar program to identify SME fund managers. And really, the things that are now coming up is, there's a lot of interest from local capital that really wants to affect SMEs with our own local standards. Historically, the fund managers that have been investing in SMEs have been investing with Western standards. So the companies that they've invested in, tend to be larger. There's a huge gap that still exists with the smaller companies that we also believe are very bankable and will create a huge impact in Nigeria. Yeah.
Thanks, Lamide. Let me come to you, Amma, and pick up on one of the points Lamide made. I think there's also a conversation around what level of ecosystem partnerships and capacity development are required, and I think Karamo has done quite a bit of that in Nigeria. Can you speak a bit from your IIGH perspective? What's your sense of the role that people outside the allocators and fund managers need to play in catalyzing these investments?
Thank you, Shirley. I think these roles are essential. When you have a market that is nascent, you need to jumpstart it. It's like having a car where the engine is stalling and it needs something extra outside itself to come and get it into motion. And that could be capacity building for bringing new products to market, because pension funding can't go and work with an emerging fund manager and pay for them to do structuring, tax, legal, due diligence, get their license, etc. That's not the purpose of investable funds. So that's where catalytic grants, warehouse facilities, and working capital facilities for emerging fund managers can enable, support some of those costs. And that's the kind of support that Impact Investing Ghana brought into the process of creating Ci-Gaba. So our pensions gave us the list of what they wanted, what the fund would need to look like. But to get it there, it took quite a bit of resources to get it there. We had the benefit of having an experienced fund manager to work with, but many times the fund manager may be experienced as an investment professional, but this may be the first time they are leading the process of bringing a fund to market. And so having thoughtful partners to walk that journey with reduces the risk significantly. And once the risk is reduced, then it's easier for institutional capital to go in. So we do need actors like Impact Investing Ghana to make that call. The thing is that the capital that's out there that's interested in solving problems like that tends to come with an impact label. And some of the impact labels are very focused. This is money for climate, or this is money for gender. However, in Africa, people make money when they have diversified strategies. Not so much single country, single sector. It's hard to make money because the pipeline of businesses you can invest in when you have a very narrow strategy is small. And if you look at who's making money in Africa, they are not coming in with those single strategies. So we also need to do donor and foundation education to ensure that the soft money that wants impact can take a diversified view. The impact will still be delivered, but maybe instead of it being delivered through 100% climate action, it will be a mixture of climate, gender, you have a little bit around resilience, and you craft an impact story that actually makes sense given the available pipeline of businesses in the country or in the sub-region. And we should begin to look at regional structures that allow us to balance the risk. When Nigeria is doing well, sometimes Ghana is not doing so well, and we need to be able to balance it. There's also regulator education. Regulators want to keep pension funds in their country, but sometimes you can attract funding from elsewhere, and your funding can also go elsewhere, and it balances off when you're trying to manage risk. So we need more complex strategies that take into account the reality of our region versus a very insular way of looking at economic development, so that we can enable our financial services companies like Petra and Axis to actually make money, which is what they want to do, whilst ensuring that we're not putting pressure on the city. So solving for, instead of just blankets throwing out, you can't invest outside Ghana at all, solving for the regulatory challenges that regulators care about, whilst giving space for innovation.
Thanks, Amma. So many points to pick up on, but I think always a helpful reminder, the role that even outside of the asset allocators and the fund managers, that other players can and have played. And I think for most of us in the room who have a bit of the history, can bear testament to the fact that Impact Investing Ghana has had quite an impact in transforming the industry over the last several years to get to this point. But I'd like to pick up on a different point you made, and Kofi, I'll come back to you. It's tied to something you made earlier. We've not talked as much about performance and track record. I think we have on the stage today some of the perhaps more forward-thinking, more sophisticated trustees in terms of being open to asset allocation to alternatives, wanting to do a lot more in alternatives, and then questions around what products are available. But I think one question is, how do you think about track record and performance in a market where there aren't as many experienced fund managers, and how do you bridge that? Today, we are at a point of dislocation where government papers are at an all-time low. That's not always the case and won't always be the case. It may make it a bit easier today to think about what returns alternatives are giving. But in the medium term, what should that balance be, and how do you think about that?
Okay, a lot of the investing teams that we're going to work with going forward are going to be new teams. You'll have individuals who have the experience and the expertise, but the teams will be new, and we're going to have to allow them to have time to grow, to develop experience, to get to the level where we're comfortable dealing with them in a Western-style private equity structure. So a lot of fund managers will come to us and say, look, make a commitment, we'll make a call according to the strategy. You can't ask questions, really. Give us the money, we'll invest, and 10 years later. I don't think that's going to work at the beginning. I think it's an interesting theoretical structure, but I suspect it's the reason why we're not seeing larger allocations from the large pools of institutional capital. At the beginning, they just need to be much closer to the process. And the governance has to allow them to have more insights. It doesn't mean they interfere in investment decision making, but there's got to be something that allows that comfort to be built. Because we also have to understand, on our side, there will be professionals like Peter and myself, but a lot of the decision makers are individual trustees representing the workers who also need to develop in their understanding and in their appreciation of risk. So the structure has to be different, and we need to work with the potential more so than with actual experience of teams. I think that's how it's going to go, but the commitment has to be made. We need to make these allocations. So everybody should be asking themselves, if that's going to happen, what is it that we need to do to get it done? It has to happen, right? And we're going to have to be forced to get into the room and figure it out. And there will be some losses, but if you have enough smart people learning and taking risk-managed positions, we should be able to figure it out and take it out over time. What we might also want to do is to try to attract some partnerships or relationships with larger firms or global firms that have done this before. Their experience might not be appropriate for our local environments, but we know how to localize things. We've done that in pensions. We should be able to do that in the other areas of investing that gets money into the real economy. So I am very optimistic, but it requires a lot of people pulling in the same direction, and it requires an environment from the policy and regulatory standpoint that allows us to take these steps a little bit more boldly. Thank you.
We'll come back to policy and regulatory, but since today is meant to be about practical steps, I have a follow-on question. What does that look like in practice? I think most funds coming to the market are a 10-year structure, as you said, 5-year investment period. Hopefully we make money and bring your money back to you in 5 years again after that. Does it look like people need to just realign expectations around this is not a blind pool and there needs to be more information? Is it pushing it a step further than that? Does the actual governance structure need to change where you're saying, I need to be able to have either more say on a more regular basis or some sort of veto, etc.? What do you think that looks like practically in terms of what could give more comfort, given you'll have emerging fund managers? Yes, back to you.
Yes, I think the governance needs to change. And there are two parts that we're thinking about this, from how do we get governance that prevents us from interfering, but have some kind of input. Does it require some representation on the governing or investing committees or boards? Those are questions we're asking ourselves now. Two, what kind of expertise is required given the limited capacity in the market that can allow us to have a number of different strategies, but still have the right expertise in the room? You know, in the developed world, you can have very specific sector-focused strategies where the investors in those strategies are all good at what they're doing. I don't think we have that luxury here. So you might need more generalist funds doing a few more things, but sharing some of the operational compliance, fund administration structures so that we can reduce costs. Everybody's trying to do their own fund. That might be a little bit more difficult, especially lack of capacity on their side, lack of capacity on our side. So those are the kinds of things that we're thinking about. It cannot be the same. It's got to be a different. How do we account for competence and scale and the lack of experience on the side of the allocators? Those things need to be solved in a different design from what is the traditional structure. On the tenor, we are not as worried about the 10-year fund life, because we believe that as pension funds, we can hold some of these assets beyond the end of their life if it's a good asset through a listing. And that's something that we can force. We're not going anywhere. Most of our funds have durations of 30, 40 years, given the average age of our investors. So at the end of 10 years, if it's a good asset, we'll continue to hold it. Just put it on the stock market. We've complained about liquidity, so we know we can't sell it. But we couldn't sell it anyway when it was in your fund, right? And as long as we have the right governance on the stock market to allow us to maintain the quality of that asset, we can hold it for a very long time. So that's less of a concern. The other concerns around structure, competence, insight, and the cost of putting these things together are the ones where we think we need to do some work to solve.
Thanks a lot, Kofi. Let's switch a bit to talk about policy and regulation. And I think we're fortunate to sit in a place where, at least from my experience, if we think of the key regulators, SEC, NPRA, we have quite open-minded regulators, accessible and are able to have the conversations. But since today is about what can we do to really accelerate this at scale, I'll come back to you, Peter. If you had a wish list to say, this is where things sit today in terms of investment guidelines, in terms of restrictions, what do you think could change from a regulatory perspective that would move the needle on being able to allocate more to alternatives and in a responsible way?
So you really want to hear my wish list?
I want to hear your wish list. Then you
just-
can blame any backlash on me for pushing you on the question.
Right. So I will start with, obviously, reducing the allocation to government securities, increasing allocation to public equities and also alternative investments. Now, one part of the regulation that really, hinders, progress or activities is the requirement to seek some kind of permission to do any foreign investments. I don't know if that is still existing or it's been changed. I know there's a lot of talk and also some works going on to reform that. But if a fund manager spots an investment opportunity, outside of the jurisdiction, trying to take advantage of it, by the time they go through seeking approval and getting approval done, that opportunity could have slipped away. Okay, so there's something called missed opportunities, which you cannot retrieve it. So those are some of the things that need to be changed. Like, why should there be another impediment of having to write or seek, some kind of approval that, okay, I've seen this fund in Nigeria, for instance, that I want to take advantage of. I think it will be a good addition to our portfolio to diversify outside of, jurisdiction, potentially also help to hedge against some of the currency fluctuations. Why does the fund manager need to seek permission to do that when they've been given a mandate from their trustees or whoever they're investing on behalf of, to pursue the right investment opportunities for them? So that's just, a couple of issues with the regulatory environment that needs to be changed. And then, personally, and obviously I'm speaking on behalf of Access as well, we believe that, fund managers should be allowed to pursue opportunities that fit with their mandates without any hindrance. And if I say any hindrance, I don't mean, they should do any kind of investments that, they feel like doing. But if they've been given a mandate by, a trustee based on whatever the investment objectives are, they've been entrusted without responsibility. They are the professionals. They can decide that, look, this allocation makes sense for this particular, portfolio. Why should you be restricted to say you can only do up to this, percentage? Like, I'm trying to figure out the rationale behind it. And I know a lot of it comes back to, access to pension funds and other investable, assets by authorities or by the government. And obviously, it's patriotic to raise funds to help the government achieve their objectives and all that. But at the end of the day, that may not have a real impact in the economy. And so, if you take infrastructure, for instance, if you have a private firm, working in infrastructure projects, building toll roads between Accra to Tamale, for instance, and you can see the potential return from an investment like that long term, Pension funds, insurance companies, all have patient capital that can invest in projects like that for the long term. If it's done and it's done well, and this has been done in other parts of the world, so I don't see why it cannot be done here. But if it's done well, it helps to cut, the costs and time of travel between here and other parts of the country. I mean, having direct impact on, productivity in the economy, and also making money for investors. Pension companies will more than readily, invest in such projects easily. I mean, and there's no, time frame for, to be restricted to. Just like Kofi said, we have the luxury of, investing even beyond the typical 10-year horizon. As long as there's income coming in to, pay our investors, as long as the project still makes sense, as long as it's still one of the best, potential investment opportunities there. Obviously, we're looking for the, good investments at all times. But if it still makes sense, there's no reason why we should, take the money out and go look for something else. So those are some of the real impactful, investment opportunities that we as pension companies are looking for.
Okay. Thanks a lot, Peter. Unfortunately, we're missing NPRO on the panel, but Amma and GVCA Amma, perhaps we'll take this to a round table. Let me ask a last question before we go to Q&A. I think this is rightly about domestic capital, but the industry got here quite significantly on the back of DFIs and development finance. And in fact, in many first-time fund managers, historically, I'm glad to hear the conversation changing, but historically, pensions have not invested in first-time fund managers. Amma, I wanted to come to you. What is your sense of the role at steady state that external development capital plays in an ecosystem like this? We're talking about trillions of naira, billions of cedis, tens of billions of dollars, but there's the majority of the capital in private equity and venture capital funds today is still from DFIs. Should that disappear? Should it still be there? What's the role medium term in your sense?
Yeah, we don't want any money to disappear. And I would say that external funding is very important. But DFIs have also not done first-time fund managers. If you look at a lot of the first-time fund managers, they may have gotten foundation funding or high net worth, local high net worth individuals. And Kurama Capital actually seeded, in its early days, a whole generation of fund managers, and then DFIs came into their second funds. And so we do need DFIs to be more innovative and to explore doing first-time fund managers. But we also need the money that can do, for example, pension capacity building, which both Axis and Petra talked about. So we've used development funding to develop pension curriculum for Ghana. It's very experiential. So we've written cases based on actual investments and funds. When pension team members come for these trainings, they actually get a data room. There's someone sitting there who's pretending to be a fund manager. They present to an investment committee and they get comments, and sometimes their investments fail and they learn. So we need money that can create those experiences. And similar to what Nigeria is doing, the money that can do the pipeline building, not just for the vehicles, but also for the SMEs. So it's assumed that once the money is there and the vehicles are created, that the projects will flow. But there's a project creation cost for the project you described, the tools. And project preparation costs money. And so being able to allow experienced product developers to access financing that's available for project preparation. And it means it has to be a certain tenor, a certain volume, so that those projects can actually become products, because the pension can't pay for the project preparation. So that's another place where this kind of funding can come in. But it needs local actors to partner with. It's very hard to do the sizes of deals we need when you're sitting in a capital elsewhere in the world. The transaction cost just forces you to do much, much bigger deals than the businesses that we actually have. And that limits, that's one of the things that limits. And it also doesn't give you don't have that deep local pipeline to be able to identify businesses and promoters that could actually bring these projects to life.
Thanks, Amma. That's a great point. And I think this afternoon there's more conversation around the SMEs in particular. It's time for Q&A, but I have one last question for Lamide. Lamide, I think like we said before, after an initial vintage of investing in private equity funds, there was a bit of a dearth for a while in Nigeria, and then a big boom, particularly in infrastructure funds. Can you speak to some of the lessons as to what changed there? And not to guide, but I think you'd mentioned earlier that currency was a big one. So in terms of fund structure.
Yeah, so I'll touch on that in a couple of points. You know, we in our conversations with the local pension funds, you know, one of the things, you know, there's several things that they're asking for. I don't know if blind pools will necessarily work. It's one of the things that we found that, you know, they want to know exactly where their money is coming, where their money is going. You know, you're investing local capital, they have local networks. Most likely their relative or their old boy from high school is an expert in that sector or, you know, works in the company that you're investing in. So they know the market very well. So there has to be a closer relationship when you're making the investments and going through the process, also adding value to the businesses. So that's one of the things we found. Another thing is definitely local currency. With local currency, you also have to have different hurdle rates and local hurdle rates for your investments. You know, historically, you know, investors were committing in dollars. Now they want to commit in naira, such that whatever happens, or in their local currency, so that whatever happens to their commitments, they are pegged to their local currency. Yeah, I think there were some other points I wanted to.
No, thank you, Lamide. Thanks for that. We'll pause here for now. I think we have time for probably 2 questions. So if there are any questions, we can take 2 questions and then come back to wrap up.
Okay, so just raise your hand and we'll bring the microphone over to you. Can this one work, please? It's working. All right. Hope you're not too shy, though. I mean, if you won't ask a question and you think somebody else can, you can just betray that person. So no, this person, I think this person can ask a question. Yeah. But non-Ghanaians, this is how we Ghanaians are. We take our time, you know. We're going to the World Cup. Come and see how we behave there. We won't score the first game. And then third game, we'll be doing calculations. Any hands up? Yes. Name and then go.
Hi, Nick as Invested World. Barbara, please, I'm calling on you. I see you from behind. To ask a question.
Is this how you tell me you are in Ghana? I honestly don't have a question because I joined the conversation a minute, but Mirabel says she will bail me out.
Thanks to the panel, and this question is more to Axis Petra. So, Shirley pushed a little bit about the kind of structures you want to see changes in the governance. We don't have a lot of permanent capital vehicles, which could be structured with more fixed income type returns. Is this something that you're interested in fund managers developing? Because I know there are quite a few in the room, and they need more ideas about what kind of structures that will come to the markets that you would readily look at.
Thanks, Marble. Peter, Kofi, please feel free.
So I'll try to answer that. I'll say it will be on a case-by-case basis. Obviously, so I'll look at it more of what is within the fund. So what are the investee companies? What are the business models that they're looking at? Is there some kind of problem that is being solved by that business model? What is the economic moat of the business? Is it a competitive business? How sustainable is their cash flow? And obviously the team behind it. Okay, so even if they don't have a very strong track record you can tell from, the team behind it, what their philosophy is, that business or investment philosophy is, behind the team. So if the business model makes sense, it's directly going to impact the economy and solve a problem. We all talk about all the different problems. We all know them. So if the business is going to solve any of those problems, and it's a sustainable, reliable potential cash flow, and the business, the team behind it, is sound, I think we'll take a close look at it and we'll be ready to, partner up. And so one of the things I can say about, Axis is we've been one of the first to invest in all the alternative investments that have been on our market. We've been very, very supportive. And we think that it's just the beginning. We took, a big chance on some of these because there was no track record when we started. And we think that long term, we want to continue to do that. And so that's one way of helping to develop our economy. So.
Thanks, Peter. So I'm hearing Axis open to PCV, but it depends on what's in the vehicle. Kofi, do you have a perspective?
I think the it depends answer is a good one. Capital has to return. So, for something like permanent capital, if the investment strategy is to invest in things that can return on a fairly regular basis, we should be willing to have capital in that, knowing that the investments are returning and you're recycling, right? We're not averse to these 10-year funds because, like I said earlier, we believe that the stock markets in Ghana today will give us a good exit option and allow us to continue to hold some of these assets over a long period of time. And if we're doing things in the more infrastructure kind of space, we're also happy to look at funds that have much longer maturities. A 15-year fund should not be ridiculous for those kinds of assets, right? So we will look at those on a case-by-case basis. Most of this conversation, though, has been around things that are fairly large. And one of the questions we would like impact investing to look at, and for all of you to look at, is how do we get the money to where a significant amount of our economic units are, individuals and SMEs. There's got to be quite a bit of work done aggregating those activities and cash flows to a level where we can look at them, right? We're not going to invest in those things directly. And so is that work being done? And that is where I'll challenge our regulators. Our regulators need to change their stance from being the ones who protect the small investor to being the ones who are able to create an environment where the demand and supply clears. Every single SME or individual entrepreneur in this country says they need capital. The pension funds are all saying we need to invest our capital. And somewhere in the middle, those two are not meeting. The excuse used to be that rates were too high, government was crowding out. So today, why is that not happening? And it should be less our jobs and more the regulators' jobs or the policymakers' jobs to ensure that this market clears. And so I'll throw that challenge out. Thanks.
Thanks, Kofi. I don't know if there are any additional questions, but perhaps we'll just, okay, please.
Just one more. We have time for one more. Gentlemen in the...
Sorry, why I asked that question, I think, to Kofi's point, I think that is really why Ci-Gaba is so needed. Because when you take a portfolio approach, it obviously de-risk the sector and the space. So that's really why you need these wholesale.
Thank you very much. Kindly stand so the cameras can capture you. Yeah, that's it. Name and then your question, sir.
I'm Richard Kwa from University for Development Studies. We are talking about issues of capacity gap. And with the industry-academia relationship, I think we can team up to come out with specific requirements, all right? Specific courses that we think we can run together. And especially with the expertise in this room, we can become the resource persons to develop this program.
Thanks. I'm not sure it was as much a question, but perhaps, given some of the work with Impact Investing and Research Collaborative, you could speak to that.
Absolutely. I think partnering with educational institutions, both the professional ones like GC, as well as academic institutions, is going to be key for us to grow this industry, because we need skills at scale at various levels in the ecosystem. So we're building some partnerships. We're happy to talk to universities that want to run courses. These courses have to be experiential, though. They need to allow practitioners to come in and teach, so they are practical and not all theoretical. And I think there can be a great partnership between universities and industry to deliver the kind of training that can actually result in the results that Axis and Petra need to see.
Thanks, Amma. So I think what we're hearing is that the capital is available. The allocators want to allocate more. There are things happening from an ecosystem perspective that are helping to move things in that direction. But we need to be a little bit more thoughtful about what sort of products are available and how we're creative about constructing track record, for instance, where they're emerging fund managers, but generally on the right path. As I see the angel in the corner, perhaps just to wrap up, what one thing, not a long conversation, what one thing each of you, perhaps starting from Peter, would you say we can do to actionably change the allocation, or to change the planned allocation in the next 12 to 24 months of pension capital in particular to alternatives? You can repeat something you said before, but just to emphasize.
So actionable, takeaways from this will be, and I'm going to just be current developments. So I know the government has a huge agenda, 24-hour economy. It's long term. I don't think it can be achieved in one term. I believe that we need to prioritize. We cannot solve all the problems, right away. Let's pick no more than 3 major infrastructure problems and partner with private sector and get them done. If this current government can achieve just 3 major, solutions or problems solved by the time the term is over, I think that will be a major step in the right direction. So if you take utilities, for instance, utility bills are through the roof.
Peter, the angel is looking at me, so I'm going to look at you as well.
Okay. Sorry.
So prioritizing key strategic objectives and partnering with private sector.
All right.
Amma.
For me, in addition to, of course, Ci-Gaba deploying the capital that it has as quickly as possible, I think we also need to build pipeline of vehicles for the moment. Right now, pensions are looking for alternatives. And so if there's anybody who has project design funding, wants to partner around creating pipeline, I think this is the moment to do that.
So partnerships around developing pipeline, and then regulators helping with approval so that pipeline can also come to the market. Lamide?
Yeah, decreasing allocation to fixed income, I think that's the biggest, and then also increasing allocation to alternative investments. We saw that in Nigeria. It hasn't yet. We haven't seen the players actually acting on it yet, but we know that they will have to eventually. Definitely wholesale platforms like Ci-Gaba that are market enablers. And I think the market is really working, but we need these wholesale platforms like Ci-Gaba to do that scale. I think we saw like Port Atlantic coming to the market here. That was private equity backed. So the model is there. We just needed to scale.
Thanks, Lamide. Kofi, last word.
For me, I think it starts from the policy environment and a coordinated effort by the policymakers in this space to get capital to flow. And that requires a change in mindset, a change in their stance, some upskilling of capacity, and a closer working relationship with the industry. Thanks.
Thanks a lot. And I think we'll hear more from policymakers this afternoon. Thank you very much, Kofi, Lamide, Amma, Peter. Thank you to all of you as well. And enjoy the rest of the summit.
Thank you. We'll now take a presentation on unlocking domestic pension capital in Africa for SMEs. It's supported by the Netherlands Advisory Board on impact investing. Let's welcome CEO Impact Investing Ghana, Ama Latte.
So welcome, Benedict. I'll be co-presenting with Benedict, who leads on knowledge on the Impact Investing Ghana team. And we're going to be sharing some excerpts from a learning report that we're launching today that captures some of the lessons that we learned on the journey to bringing Ci-Gaba to market. So we've all heard the statistics. Pensions in Africa are more than 600 billion, less than 10% in productive sectors, that includes infrastructure. In Ghana, it's 7 billion, less than 1% invested. And what we learned through the journey is that the gap is not really about capital. The gap between abundant domestic savings and starved domestic enterprises is about design, it's about governance, it's about capacity, and some of the things that came out during the panel. So Ci-Gaba is a fund of funds that was designed to bridge this disconnect. It's a $75 million fund of funds that combines some of the elements that came out on the panel. It brings in catalytic capital. This is capital that is willing to take a little bit more risk. So the pensions are de-risked. If for any reason things go wrong, and they won't, this capital will help cushion them to some extent. So it acts like a guarantee. It's also in local currency. That came out very strongly on the panel. And it includes technical assistance, which is money to support, especially some of the fund managers that are on their first fund, to ensure that's another way of ensuring that the funds will have the required return. And it also includes capacity building for the pension allocators to ensure that they can co-invest with Ci-Gaba into the funds it's investing in, build capacity, syndicate deals, and we can increase the volume of funding, not just through Ci-Gaba, but through pensions co-investing with it. So some of the milestones, we began this journey in 2021 when we did an initial scoping. And I'm not going to walk you through all the milestones because you'll be able to download the learning report and read it yourself. But we started in 2021, and tomorrow we'll be announcing a first close. And along the way, we've had all sorts of journeys that are highlighted in the report. But one of the things that this reflection enabled us to do is to create a framework for domestic institutional capital mobilization that any country or organization that is looking to unlock domestic pensions can use. And I know the text on that image is a little small, but it looks like a machine or a wheel that's working together, and it has 3 spokes. One of them is pension funds. To be able to unlock domestic pension capital, it has to be available. And the next is enabling policy. That also came out very strongly on the panel. And the third is investment-ready vehicles and SMEs. But to get these 3 moving so that domestic capital can be mobilized, you need 3 cross-cutting things. Those are the little knobs on our machine that actually go round and round. And the first is local leadership and collaboration. Because when doing something that hasn't been done before, you bring the risk down by being close to the problem that you're trying to solve and by collaborating with others that come with different skill sets. And so we've collaborated with many actors in the ecosystem. The second is catalytic grants that can help with the project preparation, etc., and catalytic capital that can go into some of these financial vehicles and make it easier for pension funding, that is commercial funding, to come in. And then the third is capacity building and syndication. Capacity building for pensions and other actors, and syndication, which is when we try and bring pensions together to invest together instead of dealing with it on a firm-by-firm basis. So in the report, you'll see some of the things I talked about explained in detail through the round circles inside each of the spokes in our wheel. And it also has recommendations for various actors to have an entry point into domestic capital mobilization. So, for example, for local leaders committed to unlocking domestic capital, we need more of you. And it's hard work. It takes time. For us, it took 5 years. And you need to have the long-term commitment to see a product or an initiative through to financing. For pension trustees and fund managers, deepen capacity, adopt blended structures, engage early in vehicle design so that you can give feedback. So promoters can design the kinds of vehicles that you are willing to put money in. Policymakers and regulators, I think we spoke about it on the panel. You need to make alternative asset allocations, something that's possible, that's flexible, while safeguarding, of course, the interest of the investor. Development partners and philanthropic actors, we talked about the need for catalytic grants that can fund design, set up ecosystem building, technical assistance to strategically unlock domestic funding. And then finally, fund managers of innovative vehicles who need to really develop the vehicles for the local domestic institutional capital, and then everything follows. And so all the design choices that Ci-Gaba made were made for its primary audience. There were times that meant picking a design choice that maybe catalytic investors would not prefer, but at the end, that is what has contributed to it getting to this major milestone. So you can download the report by scanning the QR code on the screen, and I hope that you enjoy it. This is actually an executive summary of the full report. The full report will be coming out in a couple of months, and there you will find even more detailed cases, etc. But this summary gives you a good overview of what you will find in the longer report. And one of the big things that showed up as an enabler was access to data. Pensions and everybody else in the ecosystem needs data to be able to inform the decisions they make, policymakers. And having access to up-to-date data in our context that is accurate can be challenging. And so Impact Investing Ghana has been partnering with many actors. We've been partnering with GVCA on the State of Venture Capital and Private Equity report in Ghana. And we've also been partnering on ensuring that we have data on investments and how those investments lead to impact. So I'll hand over to Benedict, my co-presenter, and he will share just a little highlights from a market mapping and sizing report that we're doing. It's a collaborative research, so a lot of partners in the room are collaborating to bring this data so we can bring down the cost of data collection, make it cheaper, and ensure that the accurate data is available more often.
Thank you, dear Amma. Thanks for the excellent presentation, but most importantly for sharing rich ideas with us on how we can work together as stakeholders within the African impact investing ecosystem to actually unlock the huge amounts of assets that are particularly sitting with institutional investors for bridging the development financing needs of the continent. And so speaking about issues of data, we at Impact Investing Ghana are actually pursuing initiatives aimed at building the database, investment database, both domestically and the investment database on the continent. And so to this end, we have partnered with a lot of organizations to actually conduct research to estimate the size of Ghana's impact investment ecosystem. And so I'm happy to observe that Susan of CU Africa is seated there, our partner in this enterprise. Thanks, Susan, and your team. Under the Ghana Impact Investing Ecosystem Initiative, as I said, we're actually working to estimate the size of the impact investment ecosystem in Ghana. But to do that, we've actually mapped up the entire ecosystem, where we identify that there are about 1,051 actors in the ecosystem that spread across all the 4 categories of the ecosystem. I'm talking about the investors, the businesses that demand capital, government policy and regulatory actors, but also the financial intermediaries that channel capital from the asset owners to the businesses that need capital. And so of the 1,051 stakeholders in the ecosystem, there are about 780 in the funder category. Let me clarify that the 780 represents both asset managers, but also those in the financial intermediary category. So it also includes all the commercial banks, but also all the rural banks that are operating in Ghana. Beyond the funder category, we also have about 245 stakeholders that we've mapped under the ecosystem building category. That's exactly where the work of IIGH is situated, but also all the other institutions involved in providing technical assistance or legal services, they are all found under that category. And so for that category, we have a total of about 245. Then the last is the government category. That has about 26 institutions there representing 4 categories. These are government ministries, like the Ministry of Finance, for instance, government agencies like the Ghana Enterprises Agency, but also parliamentary committees and another category. So under that, we have 26 representing the 4 categories on the government sector. This actually shows the diversity of the impact investing ecosystem in Ghana, actually shows the strength and complexity, but also the vibrancy of Ghana's impact investing ecosystem. So we can see that the ecosystem is actually thriving. So we are happy about that, and we still call for more collaboration to make it a lot more vibrant and in the years to come. Closely connected to the work we are doing on the domestic level is the work we've just started to do at the continental level. And so much as we are trying to estimate the size of the impact investing ecosystem in Ghana, we're also trying to do same for the African continent, which will be quite similar to the work of Impact Europe. Impact Europe also does a report to estimate the size of the impact investing economy in Europe. Also quite similar to the work of GIN. GIN also does that, but that's at a much global level. So we are actually just starting to work at the African Impact Investing Group level to do research to estimate the size of the impact investing economy on the continent. We are happy to observe that IDRC is supporting us in this endeavor. And so the work we are doing started in November of 2025 and is going to run all through to 30th April of 2028. At the African level, as I said, we are trying to map and assess the social impact investment economy in Africa. And so we are going to be working with a total of about 10 countries on the African continent to do the mapping as well as the sizing on the continent, in hope that after 2028, we'll be able to come and share that this is actually the estimated size of the impact investment ecosystem on the African continent. Not only the entire size, but also the sectoral distribution and the various country level dynamics of the countries involved in the initiative. And so the goal of this, bearing in mind that there's about an SME financing gap of about 331 billion on the continent, the goal of this is actually to bridge that financing gap, particularly again so that pension funds on the continent hold about $600 billion in assets. So the essence is to produce the data that will be used to inform conversations that would lead to the seamless deployment of capital for impact across the African continent. And so at the end of it all, we are hoping that we'll be able to produce a comprehensive report that estimates the size of the impact investing economy in Africa and its various dynamics, based on which we'll be able to use that report to do engagements with all the relevant stakeholders in the ecosystem. That includes government agencies responsible for policy and regulation, but that also includes those who have assets or the asset owners, in hope that once these are done, we'll be able to see a lot more capital deployed on the continent for impact. And so this is actually what we are doing as an institution to bridge the development financing gap that we have both domestically but at the African level, together with our stakeholders at the Africa Impact Investing Group level. And so we want to invite everybody gathered here to partner us to make history. Because if actually we are able to do this research and do it well, it would all depend on the support we get from you. And Amma just mentioned that data collection is expensive, so we actually want to collaborate to collect the data in order to reduce the cost. So we are inviting you to kindly partner us to make history by developing the first ever estimate of the worth or the size of the African impact economy. And so, sorry, we had a QR code, but I think it didn't come. So in case you need to reach us, you can reach us through the email address that we've provided. I'll be happy to work with you, to collaborate with you and your institution to create history on the African continent. Thank you so much.
Thank you. And I'd like to also acknowledge Impact Investors Foundation Nigeria, who are our co-conspirators in the co-leading with us on the Africa Impact Market Sizing Report. Thank you.